Well, guys, it's the end of the quarter, so I'm going to do a little update on the S&P 500 for you guys and how it performed, both price and earnings and all that crap, what to expect in the coming quarters, whatever. Give you some little details. So if you guys have a TSP, 401k, IRA, taxable brokerage account, whatever, this might be of interest for you. There's going to be a little bit of detail for any of you at all different levels there for the most part. I'm not going to cover individual stocks, but I will cover what groups of stocks are of particular interest or might possibly have particular interest. All right. So as far as TSP participants specifically, that area might be of interest to you if you do anything at all with the TSP mutual fund window. Because if you find some funds in there that focus in the particular areas that I talk about here, you might want to put some of your money into those areas possibly and see if it pans out for you. Right. IRA investors. Same thing here. You guys don't need to be investing in stock index funds if you can invest in something a little more narrow in focus and get better performance out of your accounts, all right? So that's kind of what we're going to cover there. Let me go over some of the details of what this is going to encompass. All right, so here's a quick outline of everything that we're going to cover in this video. I'm going to just kind of go over the main points here. Index earnings performance, let you know how that all went, what did happen, what to expect in the coming quarters and over the next year. Also going to talk about the positive breadth chart to show you how much of the S&P 500's constituents are reporting positive earnings growth and what historically they've done and where we're at in relation to that. Valuation snapshot. We'll go into all those details with that. As you see there, you can look at the rest of those sub-bullets to get a kind of a quick idea on what that covers. Historical index price and earnings performance. Basically, compares what the S&P 500's actual price has done compared to what the overall earnings have done. We'll get into more of the details with that when we get to there. And then sector-specific performances. Again, this is especially of interest for those of you guys who are into the TSP mutual fund window, or if you have IRAs or taxable brokerage accounts, all right? Some details there on where you might want to focus your attention or where you might want to avoid possibly even. Okay, and then we'll kind of brush over with the dividends with a broad stroke. I'm not going to go into specific companies and who's given the best dividends at the moment. Just going to talk about S&P 500 dividend rate and what particular sectors within the index you're most likely to find a company that is actually paying a dividend or which one is not so likely. All right, so that's all we're going to basically cover with that. And then we'll close this out with discussion about constituent changes over the last quarter. All right, so let's go ahead and move on to index earnings performance. All right, I've talked about this before. I've been keeping tabs on this data since 2015. Here you go. The very bottom here, 26 quarter one, is where we're at. I had all 503 stocks accounted for in this. There are 500 companies, 503 stocks. You got 3 of those that have 2 share classes each in the index. Fox, what was the other 2? Google or Alphabet, whatever, and brain farting on the other one. It's not Comcast? That's not Comcast. I can't remember. I'm brain farting again. It happens. Okay, so we don't need to really worry too much about that. The big important stuff here is fairly quick and simple here. Quarterly change in performance. As you see here, we're up in the upper 9% range for the quarter. That is basically a comparison of 1 year ago, or actually, this. I think it's this one. These numbers don't quite add up, so I'm trying to double check where I'm comparing to. Okay, yeah. Quarter one, 1197.36 up to 1322. Okay, it's now it's a little bit of it does look like it's off, but that's because I did constituent changes at the very end there, and I think those constituent changes might have kind of convoluted this result, but we're in the same ballpark. We're up, like I said, upper 9.5, getting 9.75% neighborhood as far as quarterly performance is concerned. Not bad, really. It's better than the last quarter, 8.63, and as well as the previous quarter, the third quarter of 25, which was 9.12. Okay, the positive breadth, we are at 70%, and as you see there, we've been up at 70% each of the last 3 quarters. We did drop just briefly below 70 until I did the constituent changes. We had 5 constituent changes this quarter, and Yeah, I think we had a couple of losers get dropped out of the index and replaced with companies that are actually doing okay. Right, and then the 12-month earnings performance, it's slowly growing. It's still not great. It's positive though. Still at plus 7.5%, but it is accelerating from over the last 4 quarters. So can we keep that trend going? We'll find out here. Okay, and charting that positive breadth that you just saw, the 70%, you can see it right here. I will tell you that the average, the mean that I've had for this over all those years is about 64, 65%. So in an average year, you expect to see about 64, 65% of the companies report positive earnings performance every quarter. And we're actually above that point. It's down just a tad from last quarter, but yeah, we're still doing all right, I would say. Yeah, it's still doing better than average. So that's a positive. That's at least a bullish indicator. Now, if we're getting down below 60, then I start getting a little more concerned. Are we getting more weaker economic conditions and weaker overall earnings growth? But as of right now, it looks like we're doing reasonably well. And looking at the near term and far term, I guess, valuations that you saw on that first that screen there. Okay, the total index market cap is 63 trillion, 642 billion. That's a lot. Okay, so just adding up all these numbers of all the companies' earnings performance, you got 5,063 on the trailing 12 months and 5,745 on the next 12 months for those same companies. That represents about a 13.4%, 46% growth trajectory. I think a more realistic number is somewhere closer to 12. I will get into that later on in the video and explain why I'm saying that, but just say. Just so you know, I'm expecting something more like 12%ish. Now, with some deviation, whatever, okay, we could be somewhere in that 10 to 14% range if we give or take a couple percentage points, perhaps. But it's double-digit percent, and you're not going to get that kind of performance out of bonds right now. So I don't think it's hard to get bonds to ever give you double-digit performance. So that still gives reason to think that stocks are still the ideal place to be. Now, I'll just say with the current and future, these numbers here. Okay, it's a little more complicated. There's times that my valuation targets are affected by things like constituent changes or stock splits, because one company's in there that and my data here is based just strictly off of earnings per share. So you have a company that, like, let's just say Apple, they did, I think it was a 5-to-1 stock split, I don't know, a few years ago, something like that. There was another one that did a 7-to-1 split. So that's going to dilute their earnings and make it look like these numbers could be a little lower than they actually are. So for that reason, I have to recalibrate my formulas here to kind of compensate for that. And, and it's not an exact science. So I'm in what I believe to be the ballpark, but it doesn't mean that I'm actually there. All right, so that's a caveat you're going to have to deal with here, right? But whatever the case, right now with my formula, I got current value without any kind of earnings growth of 66.85. Now, next year's earnings are expected to end up at 75.85. And and if we keep at this growth trajectory in that neighborhood, which I don't think will happen, but it's in the neighborhood, we could possibly see S&P 500 hitting 8,000 a year from now. Right? I think it'll be a little bit lower. I think last video I posted, I was projecting somewhere around the 7,700 range, somewhere in that ballpark. It's still a nice gain over what we have right now. So that's again why I think you should be focused on stocks and don't worry about what's going on in Iran right at the moment or with oil prices. Right? That's another can of worms. I'm not going to cover that whole story there. I could do another video perhaps on that, explaining that. But at the moment, I'm going to just stick with what's on focus with this particular video, and that's just strictly S&P 500 earnings and price performance, right? So at the moment, based on what we have here, I got a swing out target of 71.35. So, and the market tends to like round numbers to work with. So I would really expect somewhere in the ballpark of 7,100, maybe 7,150. You could even push for, but I would feel more comfortable saying 7,100 would be a reasonable top. We could, like I said, we could possibly push 7,150 just when we get rid of the jitters related to what's going on in Iran. There's still a chance we could get up in that neighborhood, right? A normal price range right now without extra volatility would be 68.85 up to 71.35. Even in high volatility, I think that's getting in correction neighborhood. That would be 64.20. A correction from what our top end target would be, by the way, not actually correction from what our most recent high price is. Okay, so I want to say we're up. We got down to like 6,200 and something, and we are currently, I want to say 65 something. Yeah, 65.82. So we're getting close to 6,600. So we're right in between that medium and high volatility range. Actually, starting to get closer to the medium right now, where our actual price is at. So I can see why there are a lot of questions right now about, are we starting to come out of this correction that we barely got into at all? Yeah, that's a possibility. I can't say for sure, but I can just tell you that based on earnings data alone, I don't see a legit reason to be in correction at all. So that's all I can really tell you. All right, so this last part here, the beer. That's I know a lot of people who don't know much about investing might find that a little amusing. Beer is bond equity earnings ratio, and basically what it is a comparison of what currently the 10-year bond yield is versus what we're expecting from S&P 500 earnings performance. Okay, 10-year yield, I don't have this. I'm not talking about bonds in this particular video. I think I remember it being somewhere in the ballpark of 5%. So what we have right now is a 75-25 beer ratio. And if you want to use some kind of a beer strategy, what that would mean is you'd want to have 75% of your money invested in S&P 500 or stocks particularly, and then the other 25% in bonds. All right, so like if you're a TSP investor, you might want to say, this is actually good for if you guys are retirees who already have, particularly if you're a retiree who has enough in your account to live off of, and you want to kind of make a risk reward, make adjustments to your risk tolerance based on how likely we are to see a correction or recession or something. The beer ratio might be something for you to consider. Deb and I have both, especially Deb, has talked a number of times about how if you have enough in your account and you want to go more conservative, then an 80C, 20G mix, if you're in a TSP, is a good general number to go with. Now, we do recommend C fund over S and I because C, even though C and S tend to have generally the same long-term performance on them, C is less volatile than S. So C is, when we do see large price drops like we've seen recently, the drops that you see in C tend to be a little bit more tolerable for people who are more prone to making emotion-driven bad decisions with moving out of stock. So it's not as scary when you're losing, let's just say 8 to 10% when S fund might be losing 16% or something. People tend to think the sky is falling, and then once everything comes back, the S fund usually is going to come back even stronger than C, where they both end up, kind of at similar levels, right? So that's basically what that entails, right? So if you guys want to do kind of a little more of that kind of a strategy where you have kind of a semi-conservative mix that is at least somewhat sensitive to the actual market conditions, I might recommend a 75C, 25G mix for TSP. Same goes with IRA investors. Maybe 75% of your money in some kind of stock funds, like I guess S&P 500, and the other 25% in some kind of a bond. All right, next slide here is going to showing what the actual price has done over the years that I've been paying attention to it versus what the earnings actually have done. Now, again, these are the raw earnings numbers. So I mentioned here, again, the trailing 12 months, 5063 is what I have in there. But you see I have a higher valuation in there. So I got 5063 in here. So it's a little bit of, it's skewed at the moment. And it actually does look like we've actually lost some earnings because, like I said, there are stock splits that can be involved, or not to mention my computation there has to be recalibrated for the actual valuation. So this doesn't really factor in which companies' market caps have the most influence here. It's a lot more complicated formula to work with, and I'm still trying to work out how to best manage. So for that reason, just know that the last slide I showed you, I think 7135 being the reasonable top end. That's probably more in the right neighborhood. This is kind of just the price, even with it being as low as it is right now compared to what raw earnings we have. It's suggesting a really strong earnings growth of well over 50%. So, but we're not really going to get that kind of growth. But just comparing only to the raw earnings, that's what it's saying. But in terms of my actual value, it actually is pricing in a slight decline. I think I had said 66 something. Yeah, 66.85 is the actual current value. So if I were to put 66.85 in here instead of 58.63, then yeah, we would have a single-digit decline in earnings is what the market's projecting. Even though it's just because the market's projecting it doesn't mean that that's actually what's going to happen, and that's definitely not what analysts are projecting so far. All right, so once I get a little more proven info that my numbers are more along the lines of being accurate than what you're actually seeing with these raw numbers, then I can, I might update this to show the more, adjusted info in there. But for now, I just want to put raw numbers in there to get a more accurate look at what really is just with raw earnings only. Okay, price versus earnings. This is the same data here shown in chart form. I talked about this before. The orange is the earnings and the blue is the price. And you see there are times the price has gone, it tends to move fairly consistently with earnings. There are times that they've priced in drops that didn't actually show up, and then the price ended up recuperating and back, recalibrating back to what earnings were kind of forcing them to do, basically. Come back down here in 2019, we had a correction there, and then came back up. We had pretty nice correlation there between earnings and price growth there again. Then we got this big drop during after COVID happened, at the end of the COVID, when the recession happened there. Did get a little bit of a drop there in earnings to go with it, but as you see there, it kind of suggests that the price was exaggerated as far as what they were expecting and what actually happened as far as that drop. And it came back up, and now we have what appears to be an exaggerated level, of price versus earnings. But like I said, with the whole calibration stuff that goes on, and there were a couple of years where I wasn't even paying attention to this and not keeping regular up with this, so. All this area here from 2023 or 4, somewhere in that neck of the woods, to more recently, I didn't have a good calibrate. I wasn't using the same formulas to work with to calibrate my earnings to the price. So are they really as exaggerated as they are? We don't know. But we know that the price was up around 7,000 not too long ago. Is it really worth staying that amount? There's a lot of question on that. The AI valuation question is where that really is a big question mark. All the capital expenditures that have been going on with the AI stocks is why that's a problem. Doesn't mean that the value is not there. It just means that there are concerns that it might not develop to that kind of fruition that they're expecting it to. But it very well could prove itself in the coming quarters or next year. All right, moving on to sector-specific information here now. Okay, so year-over-year performance. These are the 11 sectors that represent the S&P 500. NASDAQ index, you will not have financial stocks in here. You see that financials did the second best performance out of all of them in the last year, over the last quarter. Yeah. But NASDAQ, of course, is very heavy on tech stocks, which was third best. So you do have that. But now energy, we know what happened. Well, I don't know that I'd even really factor in energy with that because, they reported earnings between January and March, but in reality, those earnings were mostly from the September through December months. So we can't even really blame that on what's going on in Iran so much. But a lot of the energy stocks actually did perform strongly during the last quarter of the year. It just because of when they actually got reported, within the calendar year, it kind of gives the illusion that maybe Iran had something to do with this, but I seriously doubt it. Okay, this is what we're trying to get out of this information, though. If you want to look at some of the other stuff here as well, market cap, PE ratios in general on average, and again, these are not market cap weighted; they're just raw. How many constituents are in each sector? What percent of the market cap each sector represents? These can all give you maybe possibly useful information to work with to make your own investment decisions. Whatever your strategies are, or whatever your needs are, you can hopefully work with that info. Okay, same table sorted in terms of what are we expecting over the next quarter, or actually next year. Okay, communication services is way up at 92.8%, and this is okay. I was actually already expecting communication services to be a strong performer even before, but Now, this is being exaggerated a pretty good amount by a constituent change that happened that we're going to talk about later in the video. Okay, so I do expect the communicom services sector to likely be a decent, a stronger performer with earnings over the next year, even without that constituent change in there. But like I said, that one constituent that replaced a different one, that the new one that came in as a communication services company, and I'll get into that little detail there when we get to it. That makes it extremely exaggerated looking there. Otherwise, I'm still expecting. I think it was up around 25-30% growth out of that sector, even without that going on. So that should still tell you something that that's still a sector that might interest you. All right, so right here looks like communication services, infotech, and materials are particularly the three sectors that I am most interested in myself. The S&P 500, like I said, with that constituent change in there, we got 12-13% earnings growth expected. So me personally, I don't really want to be looking at stocks that aren't going to beat that in terms of earnings performance. And utilities is a safe sector. I don't normally like to see utilities up in that neighborhood. When it's a stronger performer, it tends to make me a little more concerned. Maybe we do have some problems here. The other area that I do have a concern with here is consumer discretionaries. We're still expecting almost 7% growth over the next year, but we got negative 3% performance, last quarter. So that part is a bit concerning to me. All right. Otherwise, though, consumer staples, that's actually near the bottom. And that's actually where I'd rather see it sitting. I want to see it going positive, but which it is. But ideally, you want to see other sectors outperforming it, because consumer staples and utilities tend to be the strongest performers when we're not doing good. All right, so since it's down near the bottom and utilities isn't exactly at the top, really just average, doesn't really look overly concerning. Like I said, utilities is something that I want to keep an eye on, but at the moment, it's not overly concerning to me. All right, I want to break down the infotech, the technology sector more particularly. So I've talked about GICS, or I call it JIC sectors. Other people might have some other way that they refer to it, but this is how all stocks are classified. They are broken down into 4 different categories, the broadest category being sector. And then the sector itself breaks down to, in this case, 3 industry groups, got software, hardware, and semiconductors as far as tech stocks are concerned. And then those break down into more with industries. You see their software breaks down into IT services or software. IT services is only expecting 6% earnings growth from 8 companies that represent it, whereas software has 20 companies expecting 17.25% growth. All right, not my favorite area of the tech sector right now. My favorite area, I've mainly been more interested in hardware myself, but semiconductors is looking really strong at the moment. Okay, hardware, you see it breaks down into communications equipment, hardware, storage, and peripherals, and equipment, or electronic equipment, instrument, and components. The strongest in there is this group of 9 here in the hardware, storage, and peripherals. So if you got, maybe you want to get good performance, I want to start looking at some of those stocks. I'm personally have been eyeballing SanDisk as one to add to my portfolio. I don't already have them in there. They're likely my next buy. So, and that is in that group there. Even when we've had down days, I've seen days where SanDisk is one of the higher performers in the index, and it's sometimes even up like 4 or 5%, even when the market's down like 2 or 3%. So that's usually a good sign that there's something good going on with that company. I'll just throw it out there, right? This is not a suggestion that you guys buy SanDisk also. I'm just saying that I'm personally looking at them as a possible buy for my own portfolio, outside of TSP, of course. All right, semiconductors. They are expecting the strongest overall growth. Got 19 companies representing them, and 14 of those are semiconductors. The other 5 are semiconductor materials and equipment. Very strong area. Again, if you guys want some good performance, from your IRAs or your taxable accounts, I want to start looking at tech sector ETFs, or more particular, hardware or semiconductor ETFs. If you don't really want to invest in individual company stocks, or if you want to look more at individual stocks that can get you even better performance, possibly, but more risk too. Those are the areas you might want to look in, and then just run your own screener for which companies are in these particular areas that look like the most that might be of most interest to you. Okay, so there's just suggestions on where to possibly focus your attention. All right, materials sector. This is one where on paper, this is where it's looking good, but being being dynamic with what I've been seeing going on with prices and what's going on with the U.S. dollar lately, I don't trust this sector as much. Now, this is mostly driven by metals and mining, as you see here. 55% earnings growth expected from only 4 companies. 1 copper, 1 gold, and 2 steel companies. And the 2 steel companies and you look at these numbers here. These are not very high. These are pretty low numbers, so which gives you a higher risk of exaggerated performance numbers here. If you have, come back in here to tech. Okay. So like right here, application software, their trailing 12-month adds up to 909. If you add up all 13 of those companies there, they sum up to 909 per share. And their next, well, actually no, 161.03, and they're expected to jump to 190.89. So when you have larger numbers and you have healthy numbers like that, there's a better chance that you're going to get the desired performance out of it than you will if you have lower numbers like this, that's 0.009, this 9 cents or whatever. So lower numbers that are closer to zero are more difficult to trust. The numbers that are further away from zero, like on the, especially on the positive side, and they're still getting double-digit performance expectations, that's generally, it doesn't necessarily mean that you're going to get better chance of better performance, but there's a better chance that these numbers are not skewed in some odd direction. That's not really realistic, I guess I would say. Okay, but material sector, like I said, these, especially gold and precious metals, they tend to move in opposite directions of the U.S. dollar. And I've mentioned before, the U.S. dollar has it bottomed out in price in late January, and it's been on kind of an uptrend ever since. I'm not going to be showing the U.S. dollar value chart on here, but just what I've been paying attention to, it's been trending up since even before Iran got attacked. So, and with that going on, like I said, it makes me less willing to trust the TSP fund. It also makes me less willing to trust metal and mining stocks. However, here's the other thing positive for materials. Okay, crude oil prices. We all know they've been going up. I think we were up at $68 per barrel or something like that on West Texas crude oil before Iran got attacked, and it's up over 100 now. Okay, well, energy stocks, we already know that, those tend to generally will react favorably to positively to higher crude oil prices, but you can't get prices too high because you have what we call a sweet spot. And as I put it here, here's your sweet spot. If you're below the sweet spot, you're coming up into the sweet spot. Right in this area, you get your maximum earnings potential, and where you have the least risk of problems there with demand tapering off to the point where it becomes a headwind for earnings. But once you start climbing above the top end there and getting up above, then it becomes more of a problem. Okay, so I usually put a chart, like a little table up when I'm explaining this to people where I'll have like 1 and 9, 2 and 8, 3, 7, so on. Yeah, a multiplication table, and it represents a balance between supply and demand, or it can also be price and demand as well. So when the price goes up, demand drops, but when you get a nice balance between the two, you have the best profit potential for the companies. Once the price starts getting up too high, then the demand starts dropping enough, now it starts working against it again. So, and that's what I'm concerned about. If we get where exactly is the top end of this sweet spot for crude oil prices, and when are we going to get to a point where these get so high that it's actually going to be a problem for both energy and material sector earnings? All right, we've already seen precious metal prices drop off their highs. So again, especially with U.S. dollar increasing in value, that already alone has given me reason to question this sector myself. So I'm not so interested in this sector personally. Maybe some of you guys are still interested. I'm not though, but I'll just give you that. All right, lastly, communication services. Here's the breakdown with them as well. Got 2 industry groups, telecommunication services and media and entertainment. I only have 3 companies in the index that are in that telecommunication services group, and they're only expecting 4.72% growth. Now, the media and entertainment, 110.93%. But again, that's where that new company came into the index, and I honestly don't know why they were added in. Again, I'll explain that when I get to the relevant part of the presentation. Just know that I'm not a fan of it. And okay, now here's the other thing here. This is actually a plus 692 because this is going from a negative to a positive. So this is positive earnings performance, not negative. But this is, this cable and satellite, that's where the new company came in that is really exaggerating these numbers. Again, I was already expecting this group to do okay, do reasonably well. So if you look outside that cable and satellite group right there of 3 stocks, maybe it might be something in there for you. Advertising, 24%. Movies and entertainment, got 4 of them totaling 71%. And then interactive home entertainment, 2 of them for 27%. I believe Netflix is one of those 2. Movies and entertainment, I want to say Disney might be one of those. I don't remember. I did not take a close look at what the stronger performance and individual performers in any group are, though. So this is where you have to do your own due diligence and figure out what in those groups might be of most interest to you, if those are of interest to you at all. All right, 3-year history on sector-wide performance. As you see here, what's had the most momentum overall? And to me, it looks like financials and tech. Energy, you saw there, they were in the doghouse for a while there, and then they actually have done pretty good over the last 2 quarters. Actually, the strongest performer now. They were actually better than the S&P 500 overall last quarter as well, but prior to that, they were in the hole for quite a few quarters. Last time they were positive before that was second quarter of 2023. So again, energy, financials, and infotech. I'm not covering financials in this one because they, as I recall, are not expecting a strong earnings growth over the next year as the other sectors that I already covered. I will gloss over energy sector though. Again, where's our crude oil price relative to that sweet spot that I talked about? Are we in there? Is there, how much more earnings growth and price growth are we going to possibly see out of this group? I don't know. But as a whole, though, right here, it's only showing 7.86% earnings performance expected. So that is nothing to really impress me at the moment. That's not even as good as the index itself. Got 3 companies in the refining and marketing area with 26.5%. Maybe one of those 3 would be of interest to you. I'm pretty sure Chevron and ExxonMobil were probably 2 of those. Brain fart on who the third one was. But maybe one of those might be of interest. I don't know. Again, I don't know how much I trust this, especially with the way oil prices are particularly being driven by what's going on in Iran at the moment. So how long is it going to stay that way before it stabilizes? All right, so buyer beware, right? If you do invest in this sector, those are the risks that you're going to take, but you will have some possible rewards to go with it too. Moving on to dividends. All right, total our dividend yield overall for the index is not looking so great. It's only 1.13%. Now again, this is not market cap based. It's just raw. You add up all the dividends that everybody in the index is paying, and then add up all their share prices, boom, this is what you get. They're not market cap weighted, so it could actually be a higher amount than what you see there. Traditionally, the index pays out about a 2% or so dividend. And what you're actually going to see there normally is between the S&P 500's performance versus TSP C Fund's performance, you can usually expect somewhere between 1 and 2% better performance at a C Fund than you're going to see from the S&P 500. And that would be because S&P 500 does not account for these dividends. Whereas your C Fund positions, all those companies pay out dividends, and then when they pay out to BlackRock, which owns the fund that you're investing in, they reinvest that all that money right back into those same positions, and that increases the share price of your C Fund. So you see it you won't see an actual dividend payment. This is actually a question that gets asked somewhat. It's not uncommon. It's not a super commonly asked question, but it's not one that's remotely uncommon either that I've seen. So hopefully that answers that question for some of you guys who might be wondering about that. All right. And also over here, what percent of the companies in a particular sector pay a dividend? Well, you see here, the energy sector, materials and utility sectors, every single one of them pays a dividend. Consumer staples, 94.3%. Where are you least likely to find a dividend? That would be healthcare, consumer discretionary. Those are more growth stock oriented, but still more than half of the companies in those sectors they still pay a dividend. May not pay, or actually infotech too. Yeah, those are more, especially growth. I did notice that with my data here, a lot of these companies, even if they do pay a dividend, they are pretty low yields. Like a lot of them are barely 1%. A lot of them are even less than 1%, maybe 1.5% at most, which is, if I'm a dividend investor, which I generally do tend to lean toward as far as positions for my own portfolio, I don't have interest in companies that pay that low a dividend yield. I'd rather have something that pays a little bit more and has earnings growth expectation to go with it. Now, we're going to close this up with the constituent changes. These are the 5 that happened this quarter. I had one that happened because Dayforce that was acquired by Thoma Bravo LP. They were replacing the index by Sienna, which is a tech hardware and equipment, communications equipment company. I did not put the market cap info in there. I'm not too concerned about it. But the other 4 in here were all done just a week and a half ago. And these are all market cap changes. So the minimum to stay in the index without risk of being bumped out of the index would be $8.2 billion. And as you see here, all 4 of these companies that got bumped out of the index match. Molina, I think that's Molina Healthcare, if I remember right, Lamb Weston and Paycom. They all got bumped out of the index because their market caps got too low to be to allow them to remain eligible to stay in the index. Now, I'm a little bit surprised with at least perhaps with Match and Molina. Now, Match, that just joined the index in 2021. But now keep that. That's something else you might want to consider is maybe this is why they are also out of the index. 5 years, they've not mustered up enough performance to get themselves out of the market cap seller as far as the S&P 500 constituents are concerned. They're still doing that bad. Maybe that, so that, to me, it looks like maybe that's a good reason why they got bumped out of the index. However, when the market cap is below, and it's less than $1 billion below 8.2 billion minimum, then it makes me wonder how much of this is just based on poor performance by them over those 5 years versus, hey, are they not getting a fair shake because, how much of the market cap did they lose during when we were at the top of the S&P 500 at 7,100 or 7,000, whatever it was, to where we're at now? Everything's prices is for the most part down. So when the price drops, so does your market cap. So I don't know. This is one of those these things that go in my head analytically, but at the same time, they have their reasons why they made that decision. And I think just the fact that they were in there for 5 years and still couldn't get themselves up for like some more padding above that 8.2 billion minimum. Maybe they're in that list of hey, you're out of here for good reason. All right, so the companies that replace them are Vertiv Holdings, which is an industrials company, electrical components equipment. Lumentum Holdings, communication, I think I looked at the wrong thing there. And then Coherent, another hardware company specializing in electronic components. And EchoStar, cable and satellite provider. Okay, EchoStar, this is the one where, the market cap tells me why they got added. However, if you look at their earnings performance, they've been in the hole. And they actually had 2 quarters ago where they reported negative $44 per share in earnings just for a single quarter. Okay, one of the criteria to get into the S&P 500 is not just your market cap has to be 8.2 billion, but also your earnings performance. You're supposed to have positive earnings over the last 4 quarters, and you also have to your total earnings have to be in the green as well. Some of you guys might remember when Tesla got added to when Tesla was trying to get into the index just before they got added. They were having the same problem. They were way up there, like a number 7 in the S&P 500 market cap rank, but they weren't even in the index because they weren't cash flow positive. They didn't have the positive earnings basically to give them the justification to give them to meet the eligibility criteria to get included in the index. So this raises a big question for me. Why is EchoStar getting added into here? Now, I talked about that communication services group here being really exaggerated by one addition. Well, there it is, EchoStar. That 1 quarter, 2 quarters ago with negative 44 earnings per share performance, until that falls off the back end there of their trailing 12-month earnings, I'm not going to trust communication services overall numbers anymore with these guys in there until then. All right, so again, buyer beware. But like I said, they were already looking, the sector as a whole was already looking pretty decent even before EchoStar got added into there. It's just now with EchoStar's really screwed up earnings, it's really exaggerating what's actually realistic for them, okay? For that group. That's basically it. All right, well, that's the end of this one. I know this one went a little long, a lot of detail to cover there, but whoever actually managed to make it all the way through this, I appreciate greatly you guys taking the time to get through this and hopefully soak up whatever info might have been useful to you. Let me know in the comments section what what you got out of this, if you can, anything that was at all helpful to you, or whatever decisions you're going to make based on this. Any kind of feedback. Hey, is this too long, or what? What was most important to you? What isn't so important to you? Whatever. Any kind of feedback, engagement helps me out here with focusing more on what is more of interest. Right. Hope you guys have a great day. Enjoy your Good Friday and happy Easter and all that this weekend. You guys all have a great weekend. See ya.